Hi, I'm Shelley.
And hi, I'm Damien.
And today we're bringing to you Nucleus Rapid Insights, where we're going to give you a quick overview of one of the areas we're looking at closely in markets at the moment. So, Damien, what area are we going to look at today?
This is the Australian property market update for December 2022. It's been a very interesting month in terms of property prices, and I'm going to start with interest rates because there's been some weird stuff going on. So, at the headline level, the RBA raised rates again, and the banks passed that on. So if you look at their standard variable rates, they all rose 25 basis points. The issue is the discounted rates actually fell over the period. And this is sort of all coming from RBA data that collect in terms of the banks. Now, the discounted rate is actually the highest difference between the standard variable rate and the discounted rate that we've seen. So it's almost 1.5% is the average, I guess, across all banks. Having said that, it doesn't take long just looking at any sort of home line comparison site, and you can sort of see that there's plenty of rates that are sort of well over 2%, less than the standard variable rates, and often the discount rates are even closer to 3% you can get from some of the banks. So, it is definitely a sign that bank competition is remaining high, but also a sign that in terms of this month, we're looking at affordability stats is a lot of what we're looking at. And so the affordability stats actually improved a little bit because we do look at that discounted variable rate. So what we do is we look at the different variable rates for owner-occupied, and we look at the 3-year fixed rate for owner-occupied, and then we take the minimum of those. Now, obviously, that's not the same for everyone, but we think that's probably a reasonable look, especially for new investors who are coming into the market, about the lowest sort of rate available in terms of affordability. The other thing that sort of really matters in terms of is whether the level of interest rates is important or the change in interest rates. So I've got a couple of charts here just to show you. One is the Australian household debt times that mortgage rate I was speaking about compared to gross domestic product. And so the idea here is what I'm trying to do is show how big are the interest payments as a percentage of GDP. And so you can see that from this line, we've got back in 1980s, it sort of rose, late 1980s, early 1990s, it rose to over 7.5% of GDP. Just prior to the financial crisis, it was closer to 10% of GDP. And right now, it's sort of closing in on 7.5% of GDP. So still not as high as sort of the last two major rate rises that sort of preceded recessions. Having said that, the 12-month change, so the actual change in mortgage rate as a percentage of GDP is about double. So the prior episodes, we saw about a 2% increase in terms of the amount of money, I guess, that's got to come out of household disposable income and switch to paying mortgages. And now, because mortgage sizes are a lot larger than what they were in prior episodes, we're talking about almost 4% of GDP. So it's about double the shock that was seen in any prior episode. Sort of all pointing to that, that change in affordability has been the real dramatic effect, and whether we're going to see, I guess what we're going to see leading on to that. I'll go into specific detail in terms of the individual houses in a minute, individual areas in a minute. But I guess the overall set to this is we've got a property calculator online. And the idea behind this property calculator is that we want to set up what the limits are to housing prices. You hear from some people, they talk about, house prices are going to grow for 10% per annum, and because that's what they've done in the past. And, if you sort of plug those numbers in and you go, okay, 10% per annum growth for the next 20 years, and wages and rents keep on going up at normal rates, then your median Sydney house price is going to be like $7 million. And it's going to be 45 times higher than the median wage. And, you'll need twice your median annual salary just to get a 5% deposit. And even if you could do that, your mortgage payment is going to be like 3 times whatever your pre-tax salary was. So it's clear that that's not a realistic outcome for how this is going to turn out. And so what we do in terms of looking at affordability is we look at 4 different factors. So first we look at mortgage payments to rent. So basically the idea is how much is a mortgage costing on a house versus renting that exact same house? And with the idea that when the ratio gets too high, people are going to switch. And you tend to see that ratio tends to top out in the past in Sydney houses, for example, at about 200%. So basically when the cost of a mortgage is double the cost of renting, that's when house prices tend to weaken and to wait for rents to catch up or weaken or fall. And vice versa, when it's below 100%, so the cost of renting is less than the cost of a mortgage payments, then you tend to see house prices go up. The next major constraint is mortgage prices to wages. So again, when that ratio gets too far out of whack, if house prices keep increasing at 10% and wages are only increasing at 5%, then eventually you get a point where the ratio gets too high. Then we have property prices to wages. So this is where how do you save for the deposit? Now, this is less important to the overall scheme. We treat this as a more minor factor. And then finally, the rental yield, so that what are investors getting in terms of their returns? And again, we don't think that's as important. We think the market is more being priced by the owner occupiers, at the moment. So where do we sit on those different measures versus history? So versus, the easiest way to look at this is breaking it up into what we call percentiles. So 100% represents the most expensive it's ever been, 1% represents the cheapest it's ever been, and you can see through looking at this chart we've got is that across houses in Sydney, Melbourne, Brisbane, Adelaide, most of these measures are at maximum. Never been higher. In terms of the most expensive, most unaffordable they've ever been. Perth looks a little bit better. Perth went through a decade of falling prices while a lot of the rest of Australia was rising prices. So Perth prices are, they're still expensive, but just not horrendous. Then when you look through the units or apartment side of it, Sydney and Melbourne look very expensive still, but Brisbane, Adelaide, Perth, again, look a little bit, they're expensive, but not at extreme levels. When you then compare that back and say, well, what does that actually mean for the ratios? So we've now got Melbourne's sort of well into this, what I'm calling the 200% club, where mortgage payments are twice the cost of rent. Having said that, rents are increasing quickly. So there's obviously a push-pull in terms of that. We've got the mortgage payments to full-time wages are, Sydney, almost 100% of a full-time wage. And keeping in mind that is a pre-tax full-time wage, is you would need to pay the interest on an 80% standard house, average median house within Sydney. If you look at the 3-month changes in those ratios, so last month we had a little bit of respite, but still over 3 months, they've all been smashed in terms of this affordability. So the reds are showing that there's been some massive changes in terms of the mortgage payment to rent affordability, massive changes to the mortgage payment to full-time wages. Property price to full-time wage is given a little bit of respite, but it's net effect on these is that most of them are really being pushed down quite hard. So what I might do now is have a quick look at individual markets, and then we'll come back to the overall outlook. So within the detailed section of our report, this blog post, we go through each one market by market. And so we can see Sydney houses, which is the ones we've got up on the screen. The chart on the left is showing how has this ratio changed over time. The one on the right is showing that percentile basis. So where does it sit in the distribution of where it's ever been? So mortgage payments to median wages, as spoke, almost 100%. Mortgage payments to rent, again, particularly expensive there, sort of 200% plus. Property price to median wage has dropped back a little bit. So, but that's a series which I don't feel is as constrained. It sort of seems to be rising, and there's the bank of mum and dad, and there's other ways to borrow money to get your foot on the ladder. To me, it's more about the more important driver for house prices is whether you can afford the ongoing payments, and that's what the top two are showing. When you look through Sydney units, they don't look as expensive. So in the sort of 1990s, we see that mortgage payments got significantly higher than where they are today. They're about another 50% higher than current levels, and almost a similar in terms of rent, significantly higher, I guess, in terms of rent. But we are back to sort of the peaks we've seen since that sort of one episode where we hit 17% interest rates. So as a longer term perspective, it's not the highest it's ever been, but there's pretty much been only one other episode back in the 90s that ended up in quite a large housing crash where we've seen Sydney units this expensive. Jumping to Melbourne, it's pretty much the same story in Melbourne, just sort of everything's wound back a little bit. So, on the affordability measures versus wages, it's not as high as the Sydney ones, but it's certainly in terms of where it's been in the past, it's equal with the sort of 1990s episode. Similarly with the mortgage payment to rent, again, sort of well over that 200% as we spoke about, and all that's sort of pointing towards similar factors to what we're seeing in Sydney. In terms of units are actually a little bit more affordable than what we're seeing in Sydney. So we haven't even reached the levels we saw in terms of mortgage payment to median wage or mortgage payment to rent. Haven't seen the prior levels we saw in either the late 90s or in the 2000s, just before the financial crisis. If you look at Brisbane's seen the most change. So it's gone from mortgage payments to median wages and mortgage payments to rent have actually been relatively cheap, a year and a bit ago, and now it's rocketed to pretty much all-time highs for both. A little bit off all-time highs, but very close. So in terms of change, it's been the most significant change, and I think as well, depending upon which measure you're looking at, Brisbane houses are one of the areas that's probably falling faster than what we're seeing elsewhere. In terms of units, they're actually not that expensive in Brisbane. So, on a mortgage payment to median wage, you're at the 43rd percentile, which is actually slightly cheaper than average. The mortgage payment to rent is it's over 100%, so it's sort of 20% more expensive. And that's, again, keeping in mind for units, you've also got strata levies and stuff on top of that as well, which would make this ratio look even worse. But this is just comparing your mortgage payment versus rent payment. But it is still lower than prior episodes. So, it's at the sort of 70th percentile. So it's expensive, but not horrendously so on the unit side. I'll jump actually to Perth, which is sort of similar to Brisbane, except for the fact that the houses, everything sort of shifted lower a little bit. So Perth went through this process, as I spoke about, of most of the 2010s. The prices didn't rise as quickly there as what we saw in all the other states, and they actually were falling for a lot of it as the mining boom came off. The heat came out of that around sort of 2015. So it's been rising, but rising from a more affordable base to start with. And so, expensive, but not terribly so. So, its mortgage payment to rent at the 61st percentile is just pretty close to where it sort of would trade ordinarily. The units again, are the most affordable, I guess, in terms of on this front. They still look cheap on the mortgage payment to median wage and mortgage payment to rent from where they've traded in the past. And then finally Adelaide. So I guess what I'd characterise it as Sydney and Melbourne are the most expensive. Brisbane catching up very quickly, and Adelaide sort of sits somewhere in between those ones. And Perth looking a little bit cheap. But Adelaide, we're talking about quite high measures in terms of where it's traded in the past. Still cheap relative to sort of Sydney or Melbourne, but much higher than for Adelaide houses and what we've seen historically. For the mortgage payment to median wage, mortgage payment to rent is sort of similar levels to where it peaked out the last couple of times. And then on the units front, not particularly cheap again, but it's not at all-time highs as of yet. So that's all each of the individual markets. Then we might jump back to just the overall market wrap. And so within the market, what we're seeing, we've got an indicator that we put up sort of looking at what are the key drivers. And we've got demand factors sort of range between credit availability, the price of credit, employment, population growth, foreign buyers, tax incentives, money laundering, and then the supply factors, restrictive planning, over and under supply, and structural change. Now, the price of credit is the key one now. For mine, I think a lot of these other factors are going to fade into the distance. We saw, in 2018, I'm just sort of indicating here that we had this credit availability where we had a big shock to that, and that was enough to send the house prices down. Whereas, and I'm looking at as a similar analogy, is that yes, we've got some of the positive factors in some of these other ones in terms of, say, tax incentives or restrictive planning and things like that. There's also a lot of structural change going on, but the one thing to worry about are interest rates.
All right, thanks, Darren. And thanks, listeners, for listening to another one of Nucleus Wealth's episodes. You can find more of our content on YouTube or your favourite podcast channel. And don't forget that we are live every Thursday, Australian Eastern Daylight Saving or Standard Time, depending on the time of the year. And you can tune in then and ask questions directly of Damien and the rest of the team, depending on what we're discussing in that episode. So thanks again from the team, and we look forward to seeing you in the next one.